Down on soaring home loan debt. Let's have a look. Hello everyone, Florian.Heise here and welcome to another episode of HeiseSays. Grab your stein of coffee. We're going to have a look at this article written by Eliza Bavin from Yahoo Finance about, the government, Frydenberg, to clamp down on soaring home loan debt. Now, before we go through this, I just want to draw your attention to these notes here, the speech from the Assistant Governor, Michelle Bullock, of the Reserve Bank. Now, this is from a few days ago, and we went through this on a live stream on my Twitch channel. And what's interesting is some of the charts here. House prices seasonally adjusted. Sydney, Melbourne, Brisbane, they're all shooting up. Canberra as well, even regional. We've looked at this many times here. Household credit and loan commitments. They've gone up for owner-occupiers, investors. Credit growth has gone up. And if we look at here, credit by sector, share of total credit. Look at housing as opposed to businesses. This is more a systematic, fundamental issue just with our culture. It's all about housing, not about business, which I don't blame people really. Here we have, we can look at loan to value ratios, and they're trending down, and debt to income ratios is climbing up. But also, a few other things to look at is that housing loans and negative equity are also going down. People have paid ahead of their loans, and they've got liquidity buffers. Now, the RBA, what they're worried about is if there's a correction to the market, if people get too far to the edge, they're forced to sell, and then the banks take a bit of a shave, so they'll lend out less, and it can be a spiral. Or if people are too close to the edge, and then all of a sudden interest rates increase, and then they have to tighten their belts, it's going to have a flow-on effect to other parts of the economy. That's really what they're worried about. They want to keep everyone spending. They want the velocity of money to continue, and not everyone just to tighten their belts and to save. So let's have a look here at how they're going to clamp down on soaring home loan debts. Treasurer Josh Frydenberg plans to crack down on growing levels of household debt, which have come as a result of Australia's soaring property market. Frydenberg said he discussed issues surrounding Australia's growing property market with the Council of Financial Regulators on Friday last week. The council comprises APRA, ASIC, and the RBA and Treasury. Off the back of historically low interest rates, Australia's housing market has seen strong growth. It is a development replicated in many other countries, Frydenberg said. A positive feature of this housing cycle, compared to that of the last, is a higher proportion of first home buyers and owner-occupiers entering the market. However, there's been growing concerns around young Aussies and particular first home buyers stretching themselves too thin with a large income to debt ratio building. Around 22% of Australians have a mortgage debt that is over 6 times higher than their income, according to the latest data from the Australian Prudential Regulation Authority. We must be mindful of the balance between credit and income growth to prevent the build-up of future risks in the financial system, Frydenberg said. Carefully targeted and timely adjustments are sometimes necessary. And this is the risk. If those people that are, their debt to income ratio is so high and interest rates start to creep up, even if the banks take account, they predict 2% higher interest rates. And even if you can still make those payments, what's going to happen is people are going to tighten their belt and they're not going to spend as much. That's what they're really worried about, everyone. That's the real concern, because then we'll all start becoming like Dave Ramsey and being super cheap, which I think is a great thing. But the pollies and the bankers, they're not going to like it. Frydenberg said that Australia's economy is expected to strongly recover as COVID-19 restrictions ease. And with that, it is important to carefully assess the growing property trend. The high levels of debt to income could potentially lead many Australians to default on their loans if they were to experience an income shock. Well, We didn't see it happen, did we? Last time. And think about it. If you've had to save so much, so hard to get in, maybe you're used to just being a super tight ass. So the RBA considers tools to ease property prices. This comes after the RBA backflipped on its previous stance that rising property prices were not its concern. RBA Governor Philip Lowe had previously indicated that it was the duty of the government to introduce measures to slow the heated market. However, Assistant Governor Michelle Bullock revealed that it was assessing tools that could be employed in Australia to manage the risks associated with house prices. The reporter's making a bit of a jump here, a bit of a jump. I mean, Governor Lowe was, I think, particularly looking at that they wouldn't use the cash rate and respond to housing prices with that. They've always said there's going to be other methods. And what they're going to do is there's going to be, remember with the interest-only periods, they're going to make that tougher. They're going to make it harder for investors to get into property like in New Zealand, maybe have high deposit requirements. They'll do stuff like that to cool the market. The ever-growing property market and any potential house price crashes pose a potential financial stability risk, Bullock said. The prospect of large declines in property prices presents significant balance sheet risks for households, businesses, and lenders, she said in a speech last week. Wow, talk about pulling out the one element in that speech. We'll have to see, everyone. I mean, what's the takeaway here? What is the takeaway here? Let's have a bit of a talk about this one. Now, I mean, they're right. The RBA are concerned about a house price crash. But they also said that the banks were in a much better position before the GFC as well. So that didn't really present a risk to the banks. It just presented a potential risk of material losses, significant losses to them, which they could handle. At least that's what the RBA anticipates. And they modeled 40% crashes. Now the question is, do we see this resulting in a property price crash? Well, people have liquidity buffers. People are not in negative equity. And, if we see a 10% or 20% shave in property prices, what are people going to do? Are they going to be forced to sell, or are they going to try and wait out government intervention? And what has the precedent been established here in Australia? Throw future generations under the bus? Intervene. Can you see anything else happening? Can you see any politician that wants to stay in Parliament or win the next election allow property correction? Maybe if there is one, it would happen at the beginning of a political cycle. And then that could be, give them enough time to get public support again. What do you think? We'll have to see, everyone. Let me know your thoughts and opinions on this one. Are you worried? Are you concerned? Do you think they're going to clamp down on these soaring debts and save everyone? Or are we at risk of a correction? I think it's a bit overblown, to be honest. As always, thanks for watching. Please like, share, and subscribe to the channel. If you're a fan and enjoy the content I find and cobble together here, there are a few ways you can support us. You can join us on YouTube or Patreon. Sign up for SelfWealth or Stake. Use our affiliate links at Amazon, eBay, Independent Reserve, or AussieBroadband. You can buy our merch from HeiseSays, use Gold Pass from the Perth Mint, or support us via PayPal. Take care, everyone. Have a great day. I'll see you next time. Bye for now.